Welcome to our channel. Today, we're diving deep into the concept of dividend yield, a critical metric for income-focused investors. By understanding dividend yield, you can make more informed decisions and potentially boost your investment returns. Stay tuned. Dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's a key indicator for evaluating the income potential of an investment. Let's define it in more detail. For instance, if a company's annual dividend is $4 per share and its stock price is $100, the dividend yield would be 4/100 times 100 is equal to 4%. This means you'd earn a 4% return on your investment through dividends alone. Now, let's take a look at how dividend yields have varied over time for different sectors. We'll compare the dividend yields of sectors like technology, utilities, and consumer goods over the last decade. As the graph shows, the utilities sector consistently offers the highest dividend yield, making it attractive for income-seeking investors. However, lower-yielding sectors like technology can still be appealing due to their higher potential for capital appreciation. Now, it's question time. How would you calculate the dividend yield if a company's annual dividend is $3 per share and the stock price is $75? Feel free to pause and think about it. The answer is dividend yield equals 3/75 * 100 equals 4%. Great job if you got it right. This calculation shows that dividend yield provides a straightforward way to gauge the income return of an investment. When analyzing dividend yield, it's essential to consider both the dividend amount and the stock price. A high yield might look attractive, but it could indicate a declining stock price, suggesting underlying issues with the company. Let's look at a few examples with real company data. For example, if Company A has a stock price of $50 and pays an annual dividend of $2, its dividend yield is 4%. Meanwhile, Company B's stock price has fallen from $100 to $50, but it still pays a $4 dividend. Its yield is now 8%. But beware, the increased yield could be a sign of trouble. Therefore, high dividend yields should be investigated further to understand the cause. Is the company fundamentally strong, or is it struggling, resulting in a stock price drop? Another critical aspect to consider is the payout ratio, which indicates the proportion of earnings paid out as dividends. A high payout ratio could suggest that the company might not be reinvesting enough in growth. For instance, if a company's earnings per share are $5 and the dividend is $2.50, the payout ratio is 50%. This is generally considered healthy, indicating a balanced approach between rewarding shareholders and investing in future growth. In contrast, a payout ratio above 100% means the company is paying out more in dividends than it earns, which is usually unsustainable in the long run. Now, you might be wondering how to find companies with good dividend yields. Several resources like financial websites and stock screening tools can help. Look for firms with a consistent track record of paying dividends and a stable to growing dividend history. To wrap up, here are the key takeaways. Understand the formula, interpret the yield within market contexts, and consider payout ratios for a comprehensive analysis. Thank you for watching. If you found this video helpful, please like, share, and subscribe to our channel for more comprehensive and easy-to-understand finance tutorials. See you next time.